Welcome into the Winter 2021 Economic Summit. I'm Nolan Baker, going to be your host today, talking about the ticking time bombs and how to defuse them. For any information, feel free to reach us online at americasretirementheadquarters.com. Of course, if you'd like to watch this replay again, this replay is going to be available on our YouTube channel. If you go on YouTube, just type in America's Retirement Headquarters, and you're more than welcome to watch this video replay. Please feel free to take a moment to pause this video if you'd like to read all of our disclaimers and go through all of our disclaimers. Today's topic, we're going to be talking about what's new around the headquarters, the economic update, the Retirement Guys formula model updates, how to invest in a stock market bubble, protections and growth ideas, taxes in 2021 and beyond, and understanding healthcare costs and income levels in 2021. More importantly, what you're also going to learn is you're going to learn some specific steps investors can take to avoid some of the financial bombs that are out there. America's Retirement Headquarters, our main headquarter building, is located here in Maumee, Ohio, but we also have satellite offices in Ann Arbor, Michigan, and also in Jackson, Michigan. Some fun stuff that's going around America's Retirement Headquarters. I'm really excited to talk a little bit about our How to Retire podcast series. So for those of you who listen to podcasts, we're on every major podcast that is out there, whether it's Spotify, the Apple Store, or just Google. Again, if you type in America's Retirement Headquarters, you can listen to the podcast, or again, go over to our YouTube channel at America's Retirement Headquarters, and feel free to listen to our weekly updates where we give 30-minute topics each and every week, discussing ideas about how to prepare for higher taxes, or to what we're talking about today, how to get prepared to invest in the stock market when it's at an all-time record high. We also recently had an article featured in USA Today and on Yahoo Finance. If you don't follow our blog, we do have a blog up at our website, America's Retirement Headquarters. I also was recently named a board member for Hooves. And so for those of you, if you are a veteran, I'd love to have you join us for our upcoming Veteran Appreciation Night. It's on March 9th from 5 to 7 p.m. It's kind of a private event that we're putting on for our clients here at America's Retirement Headquarters that are veterans. What Hooves does is Hooves helps veterans and active duty military that are dealing with post-traumatic stress to go into growth mode and be able to get their financial affairs and their personal situation focused in the right direction. So it's a great organization. You can check them out online at hooves.us. Andrew, who's up in the right-hand corner there and sitting on top of his Jeep, has recently been accepted into the Bowling Green State University School of Business with a double major in finance and business management. Also proud to announce that Connor here at the company has also successfully passed his Series 65 securities exam. So lots of great things going on here at the headquarter building, and we'd love to kind of connect with you and find out what's going on and new with you guys. So one of the most dangerous statements I think an investor can say right now is, this time it's different. For those of you who watched our great debate, which was our fall economic summit, we talked a little bit about, what we expect of the election results that have happened. But, I think a lot of the news media and a lot of the financial companies had expected some more volatility. In fact, not the market to perform as good as it has here recently. A couple of takeaways from that is, again, don't let yourself be in that situation where you're thinking this time it's different. In fact, this chart you can see from JP Morgan gives some historical average returns. And if you notice on the right-hand side on the orange section, the average investor has had only 2.1% returns, not even keeping up with inflation. And when you compare that, to something like the S&P or a 60-40, 40-60 type portfolio, the average investor year after year consistently underperforms. I think it's oftentimes because we allow our emotions to get involved in the decision-making process. Let's be honest, it's hard not to allow your emotions to get involved. And the bottom left image, you'll see kind of what the media does to the average investor. And the media absolutely plays on your emotions. So on the left-hand side there, what we can see is, mama taking great care when you look at the real picture on the left-hand side. But again, what mainstream media wants to show you is the picture on the right-hand side, which is somewhat deceptive. And keep in mind that the media is going to play on your emotions. And this time it's not different, just because of the fact that it is an all blue wave. Maybe that has you a little bit concerned. But if you look at the chart on the right-hand side here, what we can see is that the all blue wave doesn't necessarily mean that it's bad times to come for the overall market. In fact, it's happened before. Between 2001 and 2007, Republicans controlled all three branches. We had 1961 to 1969, Democrats controlled all three branches. 1937 to 1945, Democrats controlled all three branches of the government. In 1927 to 1933, Republicans controlled all branches. So the last year one party controlled all three branches was 2007. And don't let Washington be a driving factor on your equity allocation. So again, what I'd encourage you to do is I highlighted in black on the chart there the years that one party controlled all branches of the government. And what you can see is there's some negatives in there and there's some positives in there. There's more positives probably over a longer term frame than a shorter term frame, but don't let that be a deciding factor. There are some things that I think are more important to take a look at. But one of the areas that is a bit troubling is kind of the massive federal spending that the government continues to have. On the bottom right chart here, what we can see is that the federal spending set an all-time record in the year 2020. And I would not be surprised if we saw record spending again in 2021 with President Biden's current plan to pass further stimulus, looking like it's probably going to be finalized and pushed out in mid-March. But as of December 31st, 2020, the federal government has already spent $1.73 trillion in response to COVID-19. And so short term, the markets have liked that spending. I do think that long term, some of those prices maybe have been factored into the markets. If we see this particular chart here, what this is a chart of the S&P 500 index going back over the last year. Now, keep in mind, you can't invest directly into the S&P 500 index, but what this chart would show you is that, from the lows that we had at the end of March, the market has made a significant rally back. In fact, now back here into all-time record high. I do believe that the markets have already priced in the near-term additional stimulus and spending. So in my opinion, that would put the equity markets risk in an elevated position right now. Yet as this chart shows, we still have technical strength in the market. There is still momentum as the markets continue to seem to move forward. So one of the things that I would caution you about is I'd caution you about what's called FOMO, which also stands for fear of missing out. The S&P 500 index, the return comparison, if you look how the year ended up, if you take the returns of the top 5 weighted stocks in the S&P versus all 495 stocks, the other that make up the total S&P 500, what you would see is that the others, the 495 stocks, they did have some positive returns, but they were certainly mediocre when you compared it to the top 5 weighted stocks in the S&P, which had kind of gangbuster year overall to finish up 2020. Looking at analyzing that a little bit further, what we can see in the chart on the right-hand side, growth multiples are at extreme when you compare that to value. So when it comes to investing in the stock market, you can invest into large, medium, small international companies, but you can also invest into companies that are more growth oriented. And you can also invest into companies that are more value oriented. So when we think of value, we typically think of more dividend paying companies, companies that have been around a long time. When you're thinking of growth companies, you're thinking of more of the technology, companies that are bringing out new concepts and ideas and again, rapidly growing. What we can see on the right-hand side, historically, growth companies have traded for, about a 22 times multiple. And right now they're at a 41 times multiple. So you're starting to see, again, pure growth when you compare that versus pure value for forward price to earnings ratio is reaching record extreme levels. And the chart below that, if you looked at some of the price to earnings ratio, again, price to earnings ratio can be one metric that people look for when they're looking at the valuations of the market. So what we see is the price to earnings ratio on the bottom there, in 2021 or 2022, those values are getting quite a bit higher than historical means. If you add in some of the stocks that have experienced this explosive growth and just look at those big growth oriented companies, what you can see is the 2020 PE ratios in the 70 levels, or the 2021 PE ratios in the 52 levels. So if you subtract those extreme multiples, you actually bring back down the price to earnings ratio to 13.6 for 2020 and 13.0 for 2021. So what the heck does that all mean? That means that there's still, I think, some value opportunities to be able to take a look for. Again, growth is, starting to get to be a little bit extreme valuations, a little bit stretched. So you got to be a little bit careful and don't feel that you're missing out on some of these. You don't want to be the last one to the party. If we look at some of the economic data that's out there, I found this one somewhat interesting. January 8th, 1835 was when U.S. national debt was zero for the first and only time in history. I found that kind of interesting because it also happens to be the birth date of Elvis Presley, and also yours truly. It's my birthday, also January 8th. Many of you know that I had an opportunity to meet with Nobel Prize winning economist Robert Shiller. This is a picture of Dr. Shiller and I last year prior to COVID happening. And some of the statistics I think are important to take a look at when you're looking at what Dr. Shiller is saying about the overall markets. So one of them, the key takeaway here is if you look at the S&P Shiller U.S. National Home Price Index, what this chart shows here is real estate prices and home prices are back at all-time record highs. Key takeaway there is you have strong housing and home improvement do continue to create opportunities in our models. What you can also see here is that within the equity values, the values are getting to be somewhat extreme. So Dr. Shiller, one of the things that he won his Nobel Prize in for is the Shiller price to earnings ratio. And the price to earnings ratio is really trying to take a look at, are valuations in the market high, average, or low? And what we can see by this chart here is, as of the date of this event, which was, this screenshot was taken on February 4th, 2021, you had the current Shiller PE ratio is at 35.16. So we can see it over here on this right-hand side. And it's higher than where it was on Black Tuesday, but not as high as what it was in the 2000 all-time peak. So the maximum level it reached back here in this peak was 44. But what you can see is that the median average is about 15, with the mean at about 17. So the valuations are getting quite a bit high, and it is time to be a little bit careful with the valuations. So another chart that we can take a look at is the S&P 500 dividend yield. So this chart, again, as of February 4th, what it shows is that the current yield is about 1.51% if you took and added the dividends of all the top 500 companies and put them together. And so what you can see is that it has become even more and more challenging, I'd say, for somebody that's close to or in retirement time, if you're wanting to live off of dividends and interest, to find strategies and solutions to come up with good yield. On the flip end of the scale, we know that the traditional fixed rates are still at pretty darn lows, although you'll see here in a minute, they've kind of bounced back a little bit off of our summer lows. So if you're looking for things and you're looking for income, one of the key takeaways here is to make sure that you have a formula-driven approach. A formula is using a mathematical scenario on how to identify things that can generate income. Because as this chart here shows, it's not as simple as just going over to treasury rates, because treasury rates in July of 2020 reached an all-time record high at 0.62%. Now, as you can see, again, as of February 3rd, they bounced off their record lows. The treasury rate is at 1.15 on the 10-year treasury. So it's come up quite a bit from last summer, but still 1.15% is historically fairly low and makes it somewhat challenging for a retiree. I'd also say get used to volatility. Volatility can be your friend if used correctly. We saw obviously an extreme amount of volatility last year. Volatility maybe doesn't always feel good. It's like kind of going to the roller coasters, and as we get older, it may not be as enjoyable to be on the roller coasters as much anymore. But volatility can create opportunity. So my expectation is the large gains that we've had over the last several months might continue on for a little bit, but I do expect volatility to come sometime in the near-term future. And so what I encourage you to do is think about what your game plan is and what your approach is going to be the next time the markets have somewhat of a pullback. Are you going to be able to take what could be a crisis and turn it into an opportunity? And of course, that's what our office wants to help you do. But what you can see on this chart here is that intra-year declines versus the calendar year returns, which is the blue, are oftentimes pretty big differences of what actually occurs within the year. So volatility is normal, and if this is true, how does an average investor lose money in the stock market? And, why do most investors constantly underperform? So I ask you that question. How do you lose money in the stock market? Well, number one is the price declines and the investment is sold. Now that's either you had to make that decision to sell that investment, or the financial team that you're working with has to make that decision. Number two is the company goes out of business. So again, we cautioned it earlier, showing you the 20-year average returns and what the average investor has done. We want you to obviously be much more educated to make smarter financial decisions, and don't get stuck with the scenario of one of the most dangerous statements ever, thinking this time it's different. So because volatility is normal, just realize that short term, nobody can predict the stock market. With the risks that are elevated like they are right now, the companies that we continue to like are companies that have strong cash positions, companies that have low debt. Also, with the heightened risk of COVID, we continue to like companies that are considered your daily essentials. Within the sectors of the market, within the small and mid-sized category, the current filters that we have inside of our capital growth portfolio is we're looking for companies that have greater than $100 million of cash in the bank, less than 30% of long-term debt, return on equity over 15%, and then our team does an analysis to further identify which of those companies that we want. If you'd like to take a moment, you can pause this video and look at the different asset classes that we have. And of course, if you're a client of ours and you want to talk specifically about your stocks, just reach out to us. We'd be happy to go over and show you and talk to you about your individual stocks within your portfolio. In the large companies within our capital leaders portfolio, you'll see a similar type of an approach. One of the notable differences is being that these are larger companies, the requirement is more than $1 billion in cash in the portfolio. Again, we're still looking for companies that have 30% or less of long-term debt, return on equity over 15%. And again, it goes through our analysis here at our office with our team. On the large daily essentials, this portfolio is a little bit more defensive. And so what you can see is from the asset classification on the chart on the computer screen on the left-hand side, about 71% is allocated towards consumer defensive. And the daily essential portfolios consist of 100% equity securities. And really it's intended to function as a little bit more of a defensive strategy than the two previous portfolios that we talked about. It's accomplished by investing in companies that produce products which are vital to the everyday lives of consumers. These companies tend not to suffer the same drawdowns and recessions as more growth-oriented companies and allow for a moderate growth portfolio. Grocery stores and products that are found in grocery stores are really a large part of this model. The portfolio also tries to focus on generating a little bit higher dividend range than what we saw a minute ago with the average of the S&P 500. We're trying to focus on a dividend range that averages somewhere between that 2.5% to 3% dividend yield. We like it, just looking at companies that pay a little bit more additional cash flow. One of our other portfolios that we have with our growth with King's allocation, one of the nice things about this particular portfolio is it has the ability where we can be a little bit more tactical. This portfolio has the ability where it can go 40% defensive. As of the date of this recording, we've maintained a fairly full allocation. We have taken steps because it is a little bit more balanced. So what you can see is that it is a diversified portfolio, a little bit more balanced, but is somewhat fully allocated, but does give us the ability to be a little bit more flexible and be more tactical as market conditions change. The protected equity outcome, so we have a portfolio, and if you're looking to be able to take advantage of some potential growth overall in the market, but maybe have some downside protection, the protected equity portfolio is a portfolio that I'd love to have a conversation with you about. This is a position that we did add to our King's model in February 2020. And as the chart shows here, the blue line is the position that we took within our Dividend Kings portfolio. So almost immediately upon buying that position, what you can see is that the yellow line being the SPY or the broad market fell off sharply. And the blue line, which was the protected equity position that we had within the King's model, and it did go down, but didn't go down nearly as fast as everybody else. So it gave a little bit more peace of mind. Now, had we held on to that position and held on to it till February of this year, which we did for the most part, we did trim the position towards the end of the year, but we were in that protected zone. So again, we had a buffer that would have allowed us to put up to 30% of the losses if the market had not recovered like it did. But as we can see here on the chart, the market did fully recover. Again, we now know the market's back to record highs, and so that position turned profitable and continued to be a good position to have overall. We do offer this type of strategy as one of our standalone portfolios too. So the topic of how to invest in a stock market bubble, if you'd like more information on this, you can go over and listen to our podcast on this show where we talk for more in depth about this. What I would just say is I'm going to define it into two categories here. One would be defensive strategies. So this could be maybe more appropriate for people that have a shorter term time frame, maybe for a potential that need the money. Idea number one is to rebalance and maybe look at taking profits off the table. You could consider things like fixed index annuities. The rates still are a little bit higher than what you can get in a traditional bank or money market account. Now, of course, rates are always subject to change. And insurance guarantees are based upon the claims paying ability of the insurance company. They're not FDIC insured. But the other area that we like is what is called uncapped fixed index annuities. Again, on our YouTube channel, we've got a whole series talking about what a fixed index annuity is if you're not familiar with those. But many of you that are listening to today's show are clients and are also familiar with how those are utilized within your portfolio. Number two is to look at utilizing what is called a trailing stop loss. So we have the ability with our relationship at Charles Schwab where we can start to put trailing stop losses. Number three is, again, one of the portfolios that we just highlighted there, the protected equities portfolio, would allow you to still be able to participate in gains as the market moves forward, but be able to provide you some more downside protection if and when things got bad, and be able to add some more defense into your portfolio. For those of you who are looking for offensive strategies, again, maybe for some of your longer term holdings, number one, with momentum, they do say that trend is your friend, and some of the strategies you maybe want to consider there is Freedom Formula. We also have an approach called the ISERT Circuit Breaker strategy. Number two, with growth-oriented strategies, again, the daily essentials, the capital leaders, and the capital growth portfolios that we just talked about, I think are also well-suited growth strategies for those of you who are looking for more opportunities in this market right now. So then the next question becomes how to prepare for higher taxes. So now that we have a new administration, I think it's fair to say that higher taxes are going to come. The question becomes who's going to pay higher taxes? You know, the good news is there are several good things that the Biden administration has talked about, specifically plans for several tax law changes to help senior citizens and those who provide care for them. Plans to increase tax benefits for elderly who pay for long-term care insurance with their retirement savings. You know, looking at things like possibly creating a $5,000 tax credit for informal caregivers. That's family members or loved one providing long-term care for the elderly. Now, the bad is again, some of the potential changes within the plans is you got, you know, higher taxes on your net worth, you've got increased estate taxes, reduced exemption amount, potential tax increases on capital gains, tax annual appreciation in capital gains. They talked about, you know, transaction taxes for every time you buy and sell a stock bond, increases in individual tax rates. You've got, you know, increases on corporate tax rates, increased payroll taxes. So there could be a lot of increases of tax to come. So we'll see what actually ends up getting done. One of the things that I would encourage you to do is once you get your 2020 taxes done, one of the things that our office would be happy to help you out with is creating a 2021 tax roadmap. If you'd like to, you know, get our feedback in working with your accountant on your taxes, when you get your 2020 taxes completed, I just encourage you to reach out to our office and ask us to help you map out your 2021 tax roadmap. Be more than happy to do that for you. When we're looking at it from an estate perspective, you know, one of the things that they've talked about is the elimination of the stepped up basis for inheritance on capital assets. So think of that, that could have a dramatic impact on things like stocks. So, you know, maybe if you've owned stock for a long time, you have a highly appreciated position in a stock. If you own it in just a regular taxable account, typically all taxes are forgiven and you get a stepped up basis at death. The same could apply with real estate. There's been discussions about changes in the stepped up basis. Again, nothing has been you know, formalized in that category, but I think that would be a big headache for a lot of people because, you know, try to figure out what mom and dad paid for something that maybe they bought when they were working at a company, or maybe the house that they've lived in for the past 50 or 60 years, and figuring out, you know, what the basis of that is. So the rule which carries over an asset tax basis to the heirs could significantly change the tax burden. Again, I don't know that I personally think this is going to happen. Again, that's just my opinion, and quite frankly, Washington doesn't care what my opinion is. But the other thing to take note is last year they had already started making changes to targeting your retirement accounts, and specifically targeting, you know, potential estate tax issues there. There were some changes within stretch IRAs, and I think that your retirement account is probably still one of the biggest threats from Washington. So this means really more taxes potentially during your lifetime and ultimately for your heirs. So again, what's the solution? The solution is make sure if you haven't had and got our office to get a tax roadmap put together for you, we'd be happy to do that. Maybe a good time as laws change to sit down with your attorney, have a conversation. Here's some of the solutions that you want to talk to your CPA about, talk to our office about. Strategic Roth conversions, timing and amount. So maybe this is something that you're doing a little bit each and every year. Within the tax roadmap, you'll see kind of where you fall out in the tax brackets, and maybe it makes sense in your family situation to do a little bit each year. There's a tactical Roth conversion. Again, going back in time, if you look at April 2020, it was probably a pretty optimal time to take and convert part of your equity positions while the market was down versus maybe where it's at today. If we do see volatility come up in the future, which I believe that we will, that could be another strategy that you can consider to have ready to go and tactically do those Roth conversions. The other areas to look at is Social Security timing, how Social Security impacts your taxes, and it's part of the overall planning. Batching your deductible expenses, charitable contribution management, batching donor advised funds, capital gains management, account withdrawal sequencing, tax efficient investment allocations, qualified charitable distributions in lieu of required minimum distributions, charitable remainder trust, beneficiary management, tax efficient investment management, and IRA rollout to life insurance. So again, the key takeaway is just get a hold of our office at have your 21 tax roadmap put together. It certainly is good to be patriotic in this country. I love this country, but paying more than your fair share in taxes is not your civic or patriotic duty. So let's take a look at ways to help save money on taxes. And of course, we're also here to help you with your healthcare planning. Some of the changes there is they want to keep and improve the Obamacare. Over a 10-year period, Biden would keep the regulations that drove Obamacare premiums, and those premiums would be made up by increasing federal subsidies to enrollees. Increase the credit amount by giving it to people based upon the cost of the gold level of the healthcare plan, not the silver. Gold level cost is about 15% more than silver, which could lead more to utilize its benefit. So again, the key takeaway there is your accountable income levels can dramatically impact the cost of your health insurance. I would encourage you to schedule a time to work with our team and look at your accountable income levels. Of course, here at our office, Scott Kirshner is available to talk to you individually about your own healthcare questions, especially for anybody that is turning 65 or those of you who are looking to retire, and happy to help there too. Those solutions, again, are provided right here at America's Retirement Headquarters, provided by Scott Kirshner through America's Medicare Associates. We are right at 1,000 subscribers on our YouTube channel. Thank you all for subscribing to our YouTube channel. We appreciate all the feedback on the shows that you like to see, the how-to series. If you're not subscribing to our YouTube channel yet, I encourage you, again, go over to YouTube, type in America's Retirement Headquarters, and click the subscribe button. You'll find things like this video and a lot of other resources available for you to help keep you educated, informed. That way you can make smart financial decisions with your money. So another great way to stay updated. I want to thank everybody for taking time to listen to today's presentation. Again, today, talking about the 21 Winter Economic Summit. So if something that we talked about jumped out to you, you have a question about it, again, go online to americasretirementheadquarters.com. Reach out to us here at the office, 419-842-0550. We're always here and on standby and available to you. And in the meantime, stay safe and healthy. And thank you so much. We look forward to seeing you soon and appreciate all of you for being part of our family of clients.